A flat in Dawson Road just sold for $1.7 million. That is the highest price ever recorded for any resale flat in Singapore. Full stop. And in that same week, HDB resale prices recorded their first drop in nearly 7 years. So which is it? Is the Singapore resale market crashing, or is it still the hottest game in town? If you are confused right now, you are not alone. And that confusion could cost you hundreds of thousands of dollars if you make the wrong move. Stay with me. By the end of this video, you will know exactly how to read this market. Welcome back. This channel is all about making smart data-driven property decisions in Singapore without the jargon, without the sales pitch. Today, we are diving deep into 2026 resale market, HDB and private, using the latest data straight from PropNex Research, HDB and URA. Let us get into it. According to HDB flash estimates released on 1st of April 2026, the resale price index fell 0.1% quarter-on-quarter in Q1 2026. The RPI now stands at 203.4. That is the first quarterly decline since Q2 2019, nearly 7 years ago. Is this the start of a crash? Let me push back on that hard. This looks far more like a normalizing market than a downturn. The dip reflects Singapore's long-standing policy objective of keeping public housing affordable, not a structural collapse. Here's the contradiction the headlines will not explain for you. At the same time, overall price dipped. There were $412 million HDB transactions in Q1 2026 alone. That is 18% higher than Q4 2025. 190 4-room flats, 143 5-room flats, 78 executive flats, and yes, even a multi-generation flat made the $1 million list. And Nighttown set new all-time high resale price in Q1 2026. Bukit Batok, Bukit Merah, Clementi, Pasir Ris, Punggol, Queenstown, Sembawang, Sengkang, Tampines. Bukit Merah, 1.649 million. Clementi Crest, 1.51 million. Punggol, 1.47 million. That is what I mean by market bifurcation. The overall index dips, but the premium segments is as hot as ever. The resale market is not one story, it is two, and you need to know which ones apply to you. On the private side, the overall price index rose 0.3% Q-on-Q in Q1 2026. Slow headline growth, but look at the breakdown. OCR up 1.3%, strongest in 5 quarters. RCR up 0.9%, CCR recovering at 0.4%. Landed homes fell 1.8%, largely due to geopolitical uncertainty from late February that cooled the sentiment among high-quantum buyers. Despite the volume slowdown, the quality of demand in Q1 was strong. River Modern, 91% take-up at 3,267 per square feet. Pioneer Residences, 93% over a single weekend. EC sales in Q1 crossed 1,000 units. The first time in 13 quarters, HDB upgraders are active and moving. The 3-month compounded SORA stand at just 1.071%. Borrowing costs remain manageable. There are 3 forces driving this market right now. You need to understand all 3. Force 1. Supply is finally catching up. 13,500 flats are reaching their minimum occupation period this year versus just 8,000 in 2025, a 69% increase. More supply, more options, less bidding intensity. Buyers finally have leverage. Force 2. Policy is working as intended. HDB resale price growth has moderated from nearly 10% year-on-year at its peak to just 1.2% today. This is a controlled soft landing, not a crash. That is a feature of Singapore property, not a bug. Force 3. Global macro uncertainty, geopolitical tensions, trade tariffs, cautious GDP growth. These are making buyers more selective. But here's my read. When buyers hesitate, smart prepared buyers move. PropNex projects HDB resale price to grow 2 to 3% for the full year of 2026. Sustainable appreciation, not a crash, not a boom. With a resale volume projected at 26 to 27,000 units, the market stays active, less competition than 2 years ago. More inventory, sellers willing to negotiate. If you have been sitting on the fence just got a lot more comfortable to jump from. The CCR to RCR price gap narrowed to just 4% in Q4 2025, meaning CCR was practically priced like city fringe. In Q1 2026, that gap has widened back to 19%. Normal territory is returning. The EC to OCR gap sit at 20%. ECs remain a genuine value play for eligible upgraders. The OCR is the standout performer this quarter. Upcoming launches Vela Bay in Bayshore, Tengah Garden residences are expected to see strong demand. Chase MRT lines, amenities, and lease tenure. Those are the fundamentals that hold value. I would be doing you a disservice if I only gave you the upside. Here are the real risks. Capital growth in 2026 will be selective, not broad-based. Key risk: a global economic slowdown, unexpected policy tightening, and sustained geopolitical uncertainty, and a longer-term structural shift once the voluntary early redevelopment schemes replace SERS. HDB resale price appreciation may slow further. If you are buying a HDB as a home, fantastic. If you are purely buying for investment gains, recalibrate your expectation now. Here's your game plan. 3 concrete steps. Step 1. Do your homework on the specific segment you are buying in. A 3-room flat in Woodlands behaves very differently from a 5-room in Queenstown. Research your micro market, not just the index. Step 2. Get your finances sorted before you view a single unit. SORA is just over 1% right now, but that can change. Know your budget, get your HFE letter or AIP in place. Prepared buyers win. Hesitant buyers lose units. Step 3. Think long-term, buy fundamentals. PropNex overarching theme for 2026 is clear. Precision over exuberance. Buy the flat or unit you will be proud to hold for 5 to 10 years. Stop trying to time the market perfectly. Nobody does, not even the pros. If this video helped you, hit that like button. It genuinely helps more people find this content. If you're still unsure whether now is the right time for you to buy, sell, or upgrade, drop your situation in the comments or contact me. Tell me, HDB or private, your budget range and your biggest concern. I read every comment, subscribe and hit the bell. I break down Singapore property data so you can make smarter decisions. See you again.